Hello, I hope everyone is well. My name is Louis Green. I'm an investment advisor with Prestige Wealth. I partner with savvy advisors to offer wealth management services to my clients. Now, I recently had the opportunity to learn more about Circle and its restricted stock unit program, aka its RSU program. As a result, I thought it would be valuable to share some initial thoughts on the program and how it may fit into the financial plans of Circle employees. Please note, I am not providing legal or tax advice in this video and podcast. First, I want to touch on some considerations around the company's restricted stock program. Given that Circle only recently went public on June 5th and 25 at $31, this is not about making specific recommendations on what to do with the stock. Instead, these are high level ideas intended to help frame the conversation and highlight areas that may be worth further explanation. Now, in my work, I view decisions like these through the lens of a comprehensive financial plan, guided by the framework I outline in my book, Five Steps to Retirement Planning. You can get that book on Amazon or email or call or text me for a free copy. Now, that framework includes investment planning, tax planning, financial planning, estate planning, and lifestyle planning. Each of these areas plays a key role in how equity compensation should be evaluated and integrated into a broader strategy. Now, these thoughts are simply a starting point. Every situation is unique, and it's important to evaluate these ideas in the context of your own financial goals, your risk tolerance, and your long-term objectives. Let's get started. We'll start with equity compensation. Now, equity compensation has become one of the most powerful ways technology companies reward and retain talent. Employees at companies like Circle may receive restricted stock units as part of their compensation package. While equity compensation can help create wealth, it also introduces complexity. Taxes, concentration risk, liquidity decisions, and long-term planning all play a role in turning equity compensation into lasting financial security. Now, restricted stock units are a form of equity compensation that grants employees the right to receive company shares after certain conditions are met and can be time-based or performance-based. Now, in a typical program, employees are rewarded a certain number of stock units or RSUs on the grant date. The shares then vest over time. When shares vest, their market value becomes taxable as ordinary income. Once vested, employees can typically sell or hold the shares depending on trading windows and company policies. For employees of a growing fintech company like Circle, RSUs can represent a large portion of total wealth accumulation, which makes thoughtful planning critical. Now, let's apply my 5 steps to retirement planning process to Circle's RSU program. First, we will start with investment planning. The biggest risk with stock compensation is concentration risk. Now, employees naturally accumulate exposure to their employer through salary, bonuses, RSUs, and stock options. Now, if too much wealth is tied to a single company, volatility in that stock can significantly impact long-term financial security. Key investment considerations include paying attention to how much of your net worth is tied to a single company, having a plan to reduce exposure if that concentration becomes too high, and ensuring all your investments align with your retirement goals. I recommend paying particular attention to your asset allocation, specifically your stock to bond mix, and making sure it aligns with your long-term objectives. Now let's move on to tax planning. RSUs are taxed differently than many other investments. When RSUs vest, the fair market value is taxed as ordinary income. The company typically withholds shares for taxes. Now, future gains are taxed as capital gains. Planning opportunities may include managing tax brackets, such as timing sales, to avoid pushing income into higher brackets, and implementing capital gains strategies. These strategies include holding shares long enough to qualify for long-term capital gains treatment and selecting specific tax lots that may provide the greatest benefit each year, such as those with unrealized losses. Because RSU vesting can significantly increase annual income, Proactive tax planning can potentially result in substantial savings over time. Now, let's discuss financial planning. Restricted stock units can play a major role in your broader financial goals. Employees may use stock compensation to fund home purchases, a college education, reduce debt, or to fund retirement savings. You should consider how your RSUs can help with your overall financial plan. When we work with clients, we provide a written financial plan that addresses areas such as their cash flow, emergency reserves, and retirement readiness. A well structured plan integrates RSUs into a broader financial strategy rather than treating it as isolated compensation. Now, let's move on to estate planning. As equity compensation grows in value, it can become an important part of your estate strategy. You are never too young to begin estate planning. Key considerations may include creating a will or revocable trust to ensure your wealth is transferred according to your wishes, as well as implementing gifting strategies and other tax efficient wealth transfer techniques. You should also consider establishing essential documents such as a power of attorney and a living will. Make sure to keep your beneficiary designations up to date. Please consult with an estate planning attorney if you have any questions regarding your estate plan. The final step is often overlooked, but may be the most important. Lifestyle planning focuses on aligning your financial resources with your personal goals and life priorities. Common questions include: when can I achieve financial independence? What role does work play in my long term goals? You should be intentional about your long term plans. Look beyond work and consider factors such as planning for healthcare expenses, being thoughtful about how you will spend your time in retirement, and making an effort to stay connected with friends and family. To wrap things up, restricted stock unit programs can be incredibly valuable. For employees at innovative fintech companies like Circle, equity compensation can become a powerful driver of long term wealth. However, the key is turning stock compensation into a comprehensive strategy. If you receive restricted stock or equity compensation, it may be worth reviewing how it fits into your broader retirement strategy. I help professionals evaluate their financial plan across 5 key areas: investments, taxes, income planning, estate planning, and lifestyle planning. If you would like a complimentary review of your retirement strategy, you can email me at louis.green@savvyadvisors.com, call me at 917-590-0552, or schedule a conversation with the Calendly link I will post on YouTube and the appropriate podcasting channel. Remember, a thoughtful plan today can help ensure that equity compensation becomes not just income, but lasting financial security. Please reach out, louis.green@savvyadvisors.com, or call me at 917-590-0552 if I can be of any assistance. Have a great day.